multi-asset strategist at State Street Global Markets. He joins me now live from Boston. So great to see you. Warnings coming through from Larry Fink. And it is interesting to sort of take a step back and see that the banking sector has been enjoying super low interest rates, barely any inflation, easy money, and things have shifted dramatically here. Do you believe that there is possible contagion that we're not taking into consideration?
Thanks, Olivia. Great to be here with you. Look, I do think there is possible contagion. There's always the risk of it. But I also think that the system is in pretty good health. I agree it's too early to tell. That doesn't mean there's something out there waiting. It just means we need to sort through a lot of this first. But I think to the main point here, this isn't happening in a vacuum. Some of the volatility we're seeing in banking is directly due to the fact that we had a system that was pushing money in, a lot of money in through central banks, which then, as we started to build up price pressures and inflation, reversed it. And banks happen to sit at that intersection between the real economy and financial markets. So everyone is involved, whether they like it or not.
Exactly, and they benefit from easy money, and now they are feeling the brunt of a tighter monetary policy environment. Credit Suisse is a systemically important bank. It has, good liquidity levels. But when an important bank of this nature is dropping to record lows on its share price, and there is so much concern about its future, what do you believe that means for other banks? If we look under the hood, what would you be looking for within the financial sector?
Well, first of all, I think that we've come a long way. We're always trying to sort of regulate for the last crisis. But I think if we do look at the asset side of banks overall right now, including the ones that have been in question, the ones that have been in the news, the assets are actually okay. These aren't assets that were taken with undue risk. It was really a more of an interest rate risk question, as you mentioned in the start of the show, rather than credit risk to start. However, that doesn't mean that people shouldn't be worried about credit risk. In fact, there was probably too little attention paid to it. So I think that's the answer here, is that we need to know whether or not we're moving into more of a financial contraction in the real economy. And that's when we will start to see issues with the asset side. However, I think that banks overall are in pretty good shape with their assets, and this is much more of an interest rate question.
Yeah, I mean, I'm looking at the credit default swaps of Credit Suisse, moving at 1,200 basis points. How worrying are those signals? And then I look at what the US 2-year bond is doing, and there's also a worrying signal there as well. Is this something the central bank should be taking into consideration when thinking about whether they should hike during their next announcements?
It should be. Remember, a banking crisis would be inherently disinflationary, and that's not the way they want to achieve their goals. However, so they don't want to push the system into that direction. However, they still need to look at this from the real economy and from the price pressures that we see. And the market has been adjusting so quickly, as you mentioned. We were just a week ago, we were looking at a higher terminal rate for much longer into 2024. That has just quickly reversed into cuts expectation this year. And all the while, inflation pressures haven't been tamed and are nowhere near the goal of central banks. So the Fed, the ECB, they continually need to look at that from a real economic perspective and keep a grip on this without pushing banks into crisis. And that is going to be a difficult balancing act. But I think that inflation still has to be the lens we view this through.
I think as a depositor, if you're banking with Credit Suisse, for example, or any of the banks that you've got exposure to, there is worry that people are going to be pulling out deposits, and that would cause a run on the banks. Are you anticipating this to happen, where people are starting to look for stronger players? Do you think there's going to be a big shift?
Well, it's already happening to some degree. And there is some irrationality to it, especially with insured deposits. No bank can, no matter what their position is, can survive a big run. It's just, that's not, in a world of fractional banking and maturity transformation, we need to have trust in the system, which is why those insurance levels were put there. I think that once calm prevails, that we'll see that the system is actually pretty strong. But the beneficiaries to some of those runs on the regional banks, for example, have been the large banks. So we've seen tremendous depository inflow into the systemically important banks, the larger banks in the system. So I don't think that this is necessarily just straight on knock-on effect into worry. I think it's about shifting preferences for now.
Dan, Gerard, thank you very much. Good to have you on the show. I think we will find out more as the days go on. We've been dealing with so many surprises this week. Thank you, sir, for your time.